Welcome to the deep dive. Today we're tackling a question that's, well, everywhere. Is King Dollar's time nearly up?
Yeah, you hear it a lot.
We've been reading the latest Macro Butler newsletter. It's called Too Early to Bury the King Dollar, and we're going to unpack their take, give you a clear view on the dollar's real standing right now.
Absolutely. There's so much noise, isn't there? Headlines screaming about the dollar's fall, the rise of alternatives. What we want to do is cut through that, look at the actual arguments, the data the Macro Butler presents.
Exactly. You've got these predictions of doom on one side and then solid arguments for its staying power on the other. The Macro Butler's definitely in that second camp.
Right. And they don't ignore the context either. They mention the current political climate, calling it forward confusion, sprung up by the manipulator-in-chief, and how that affects how markets feel.
Okay, let's dive in then. How has the dollar been doing recently?
Well, the newsletter acknowledges it. The dollar has dipped a bit against other big currencies, the G10, since the year started.
They called it a Jubilee year, right?
Yeah, sort of tongue-in-cheek. But and this is key. They immediately say, look, this isn't new. We've seen dips like this before. It doesn't mean the dollar's on its last legs.
Okay, so context is everything. We need to look back a bit.
Definitely. The newsletter gets into the history, and it's fascinating, actually. Back in 1977, the dollar's share of global reserves, what central banks hold, was huge, like 85%.
85%? Wow.
Yeah. Now, fast forward to late 2024. The IMS data, the COFR stats,
Yeah, the official number.
show that share down to about 57.4%.
Yeah.
It's the lowest since 1994, and a drop even from 66% back in early 2015.
Okay, 57.4%, that sounds pretty significant. The newsletter even projects it could go below 50% by 2034 if the trend holds.
It does, and that sounds dramatic.
Yeah.
But here's the kicker, the really interesting bit. The Macro Butler points out.
Okay.
The dollar's share already dipped below 50% once before, back in 1991.
Really? I didn't know that.
Yeah, after the inflation troubles of the 70s hit confidence. But then what happened? In the 90s, it bounced back. Central banks started buying dollars again, right up until the euro arrived.
So it's not necessarily a terminal decline. It can recover.
Exactly. History suggests it's not a one-way street.
Okay, that's crucial context. What about the challengers then? The euro, other currencies.
Well, the euro share is up slightly, around 20%, highest since 2022. But the Macro Butler says it's basically stagnated overall.
Not really taking over then.
Not really. What's actually gaining ground quietly is this. They call it a messy pile of other currencies.
Other currencies? Like which ones?
Well, interestingly, not the Chinese renminbi as much as people expected, despite all the hype when it joined the IMF's SDR basket.
Right, the special drawing rights.
Its shares actually slid back,
Yeah.
even behind the Australian dollar now.
Wow. Why?
The thinking is central banks are wary. China's capital controls the funny money rules, as the newsletter puts it.
So trust and ease of use are still major factors.
Huge factors. And the IMF found 46 central banks actively diversifying, looking for yield in non-traditional currencies during the low-rate years.
Okay. And they also mentioned the dollar index level compared to gold.
Yeah. Another interesting point, the dollar index itself is basically back where it was in December 1977. But gold, the price of gold in dollars is 8 times higher now.
8 times. Which brings us neatly to gold's role in all this.
Gold's treated differently by central banks. It's a reserve asset, yes, but not a foreign exchange reserve. So it's not in that COFR data we talked about.
Got it. Separate category.
But the behavior around gold has shifted dramatically. For decades, central banks were selling it off. Then, about 10 years ago, they flipped, started buying again.
And that's accelerated.
Especially now with the world becoming more polarized. It's like a hedge. Even if official dollar holdings dip, they're building up gold reserves on the side.
Makes sense in uncertain times. Now, the newsletter also mentioned something called the Genius Act. Sounds ambitious.
Yeah. It's the Guiding and Establishing National Innovation for U.S. Stablecoins Act of 2025. Basically, it's about regulating stablecoins.
Okay, explain stablecoins quickly.
They're digital assets, right? Designed to hold a steady value, usually paid one-to-one with the fiat currency, like the dollar.
Yeah.
And they're meant to be decentralized.
And this act wants to regulate them, bipartisan support.
Yep, includes anti-money laundering stuff, Fed oversight for the big players.
Okay, so how does regulating stablecoins tie back to the dollar's dominance? Seems counterintuitive almost.
Well, the Macro Butler argues it could actually boost the dollar. They see stablecoin supply potentially exploding maybe from $230 billion now to $2 trillion by 2028, thanks to this act.
$2 trillion. How?
Because these stablecoins are backed by real dollars, or things very close to dollars, like short-term U.S. Treasury bills, T-bills. To maintain that peg, issuers like Circle have to hold massive reserves.
Ah, so more stable coins means more demand for dollars and T-bills to back them up.
Exactly. They project maybe $1.6 trillion in new demand for T-bills by 2028, just from stablecoin issuers needing reserves.
So it's like the dollar finding a new life, a new form in the digital world, potentially sidestepping things like tariffs, too.
That seems to be the argument. It reinforces the dollar's plumbing in the financial system, just digitally.
Fascinating. Okay, another piece of that plumbing. The Fed's swap lines. Why are they so critical?
Oh, they're absolutely vital. Think of the Fed as the world's lender of last resort for dollars. These swap lines let other central banks borrow dollars directly from the Fed when markets seize up.
Like in 2008 and 2020.
Precisely.
Yeah.
Non-U.S. banks and companies need dollars constantly, usually getting them from the FX swap market. Huge market, 97 trillion or so, mostly dollars.
97 trillion.
Yeah, but there's a mismatch. They borrow short-term swaps to fund longer-term dollar assets. When panic hits, that short-term funding dries up. That's when the Fed steps in with the swap lines. It prevents a global dollar shortage spiraling out of control.
But there are questions now about the Fed's willingness.
Some European policymakers are apparently asking that, yeah. And the Macro Butler raises the risk. What if the U.S. decided to use access to swap lines as, like, an economic weapon, or just pulled back in a crisis?
What would happen then?
Well, likely a massive spike in the dollar, panic selling of U.S. assets by foreigners desperate for dollars. It could seriously accelerate de-dollarization efforts long-term.
A double-edged sword for the U.S. then.
Very much so. And you see moves like China issuing its first sovereign dollar bond in Saudi Arabia, recently raising $2 billion, high demand. The newsletter frames that as China trying to build alternative channels, reduce reliance on Fed-controlled liquidity.
Strategic positioning. Okay, let's talk tariffs and investment. The newsletter links tariffs, foreign direct investment, FDI, and the dollar.
Yeah, they make an interesting point. If tariffs are partly meant to encourage companies to build factories in the U.S. boost FDI, then historically, higher FDI into the U.S. is actually correlated with a stronger dollar index, the DXY.
So attracting investment strengthens the dollar.
Seems that way, according to the data they cite. Fostering FDI could be a win-win for growth and the currency.
And what about the business cycle? Like you mentioned the S&P 500 to oil ratio.
Right. The Macro Butler observes that historically, when that ratio falls below its 7-year average, signaling a shift from boom towards bust, that's often when the dollar index has its best 12-month runs.
Interesting. So a slowing U.S. economy hasn't always meant a weaker dollar.
Not necessarily, especially relative to other currencies. They contrast that with the gold-to-bond ratio, which they say hasn't been a reliable dollar predictor in inflationary times.
Okay, so for equity investors listening, what's the takeaway? How does the dollar's strength or weakness affect stocks?
Historically, the newsletter points out a weak dollar index, a falling DXY, has often signaled an economic bust coming in the U.S. And that usually means lower corporate earnings, lower EPS for the S&P 500.
And valuations, too.
Yeah, typically. A weaker dollar has often coincided with lower PE ratios for U.S. stocks. Investors just aren't willing to pay as much.
So careful what you wish for if you're hoping for a weak dollar just to boost exports.
Exactly. Now, the Macro Butler is pretty blunt about the alternatives, specifically the euro, pound sterling, and yen. They don't see them as safe havens.
Why so negative on Europe, for instance?
They list several big concerns. Sovereign debt risks the chance a country defaults. The war in the region, obviously. And the potential for capital controls if things get really bad, pointing to historical examples like the London Stock Exchange shutting in WWI.
Serious stuff.
Plus, they're critical of what they see as European economic models. Socialism, protectionism, red tape, arguing it hampers growth compared to the U.S. They even mentioned Japan and China reportedly selling European debt.
And the scale difference.
Yeah, the U.S. market is just vast. NYSE capitalization bigger than all of Europe combined. Consumer spending is a much bigger driver. They paint a picture of Europe being much more fragile.
Okay, what about China selling U.S. treasuries? That gets a lot of headlines.
It does. And the Macro Butler acknowledges China has been reducing its holdings, especially since 2014, and more so after threats of sanctions over Russia.
So is that a major threat, the BRICS bloc?
The newsletter downplays BRICS as more geopolitical theater, not economics in this context. They suggest China saw Russia getting kicked off SWIFT as the financial system being weaponized, and feels the U.S. is prioritizing geopolitics over economics with the global South. But they also note an interesting correlation. As China sold treasuries since 2013, its own currency, the yuan, has generally weakened against the dollar.
So it hasn't necessarily hurt the dollar overall.
It seems not, or at least other factors have offset it.
So wrapping up the main argument, king dollar isn't dead.
That's the core message. Too early to bury the king dollar. The newsletter concludes it's still very much alive. The real risk, they argue, is betting heavily on the UK and Eurozone, given the sovereign debt issues, war risks, and potential crackdowns via things like central bank digital currencies, CBDCs, leading to surveillance or capital controls.
And the tariff argument about the Great Depression.
They push back strongly on that. They argue blaming tariffs is a historical misreading, that the real drivers were European sovereign debt imploding and the subsequent banking crises.
Okay, so if that's the diagnosis, what's the prescription? What investment strategies do they recommend?
Given the outlook they see an inflationary bust coming, the focus shifts. It's about return of capital, not just return on capital. Preservation first,
Meaning?
meaning own real assets. Physical gold and silver are strongly recommended. They're anti-fragile, no counterparty risk.
Outside the system.
Exactly. For cash, be active. Use short-dated, high-quality investment-grade U.S. dollar bonds, T-bills under 3 months for real stability.
And stocks.
Be selective. Low-leverage companies. Strong earnings, strong free cash flow. Companies that have paid their taxes. They favor energy and commodity producers over consumer-focused stocks right now.
Got it. And their very latest market view as of early May 2025.
They see the U.S. in an inflationary boom still. But that S&P 500 to gold ratio indicator is flashing red. It's been below its 7-year average for a few months now. They think an inflationary bust is closer than many expect.
Just stay alert.
Stay calm, be disciplined, use the data, don't get swept up in the forward confusion or the tariff tantrum arguments.
And the bottom line on the dollar versus gold.
They expect the USD to rise against other fiat currencies, especially during trade wars or geopolitical stress. But against physical gold, they see the dollar continuing to depreciate. Gold offers that autonomy, that protection from currency issues and centralization.
So quite a nuanced picture. The takeaway really is, despite the constant chatter, the Macro Butler makes a strong case that reports of the dollar's death are greatly exaggerated.
Yeah, its role is deeply embedded. Stablecoins might even give it a new digital lease on life. And the alternatives, well, they have their own serious problems.
And the investment advice is pretty clear. Focus on preserving capital, real assets, careful cash management as we navigate what could be choppy waters ahead.
That's the gist of it. Prepare for that inflationary bust.
Okay, that's a lot to think about. A really insightful perspective. So here's a final thought for you, our listeners. How do you think this rising geopolitical tension, combined with this explosion in digital currency tech, will really redraw the map of global financial power? Something to ponder beyond the day-to-day headlines.
Definitely worth considering the long game.
Thanks for tuning in to the Deep Dive.